Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good afternoon. Ira Epstein of Linn & Associates with your metals market update for this Monday, the 12th of June, 2017, about 3:20 p.m. Central Daylight Time. I've been tongue-tied all day. I've tried to do a bunch of videos, was wrong. My day started off, I sat on the cord where I normally do my subscriber video. I didn't sit. I rolled the wheels over it, snapped it like that, couldn't do that. It's one of those days where I know I'm going to go home, climb into bed, and wake up tomorrow and have a much better time. I'm sure you've all gone through the same thing. All right. What we have coming up now is pretty simple. We have this testimony of Jeff Sessions tomorrow. We have the FOMC meeting going on right now. Brexit, and this for the metals, was a failure vote, the stamp election vote, and the metal markets are backing down a bit in front of the FOMC and Mr. Sessions. Now, Mr. Sessions, that shouldn't be one of these events that breaks the gold, because if he says something wrong, people will run to the gold. If he says nothing wrong that hurts the president, well, that's his job, not to hurt the president, if you think about it to a degree. The dollar index, I can understand back and forth action right here, because as much as the market believes, and it's 99.6% probability right now, according to the CME website the last time I looked at it, that there's going to be a rate hike, it's considered a feeble one. The economic data is not exciting. We're in summer for all purposes. I think June 21st is officially summer or something right around there. And what's going to happen now is the markets are concerned that the investors are turning attention away from certain things, and maybe that's what we're seeing in the metal markets with this back and forth action. When you look at the weekly chart, in all honesty, the last time we hit an upper Bollinger Band was last summer, June and July. During that whole time frame, you never got up on the weekly chart until last week, and you hit it again. And just like we did back here, when you hit it, you often back away from it. So we're getting that backing away from it. Now, something else I've decided to put on this particular chart. I've got in green the 100-week moving average of closes, the 200-week in the gray, and the 18-week right here. The market's over all three. That's nice and bullish. You were that way in part of these up here as well, don't get me wrong, and you still broke down. But I think the fundamentals are a bit different right here, and a lot of traders you're going to hear talk that maybe, and I can only use the word maybe, this is where the gold begins its turn back to the upside. It's going to be hard to tell. Summertime's always difficult, and we'll see if that turns out to be the case. On the August gold, and now I've left the June, I'm into the August, you've gone from 1298.80 to 1268.90, and the close today was under this close of 1270.10 that I'm pointing to right there, so the thrust is to the downside. Now on the bar charts, it's not quite that way. On the bar charts, as you'll see in a moment how the swing lines look, they are still looking pretty good to the upside, but we have corrected in the market $30 in very fast order. And on the swing lines, you still have the pattern of higher lows, higher highs. Now, to keep the chart really good and bullish, you don't want to take out 1261.30. If you take that out, you're going to end up with a pattern of a higher high and a lower low, so it has to do more work in order to get bullish, but more important, where would it be in relation to moving averages? Well, the first damage was done today on the close by closing underneath the 18-day moving average, so you've turned the bias of the market down. The trend is up, the bias down. You're still far away from the 100-day average, but that's important to pay attention to. Support is now moved way up on the chart. I remember when it was here in the 1212 area, it's now up to the 1250 area. So that's good news for the market, and that's the support of the lower Bollinger Band and the 100-day average of closes. And again, when you look at Bollinger Bands, the odds of staying above or below is only 5% of the time. So the first challenge is, if you're falling to it, It's a support zone, the resistance zone. And money often flows out of the markets when these points are hit initially. I'm not saying always stays that way. I'm giving you what I teach. The slow stochastics had been embedded back through here. Now, here's Wednesday. They were embedded. On Thursday, the red number closes under 80. You can see that right through here with the 76 reading. Okay? So you get that, and that often leads, unless you re-embed instantly again, to price and the 18-day average coming together. When they first come together, the market often is just left in an overbought status. So you go from a bullish embedded to overbought. And in order to get out of that, you got to take both numbers out of 70s or 80s. And now it's occurred. So you have a market that's getting more in balance with itself. It's no longer overbought. And when you go to the gold daily chart of ETF gold, breaking down a little bit, higher lows, higher highs, same pattern, no longer overbought, lost its embedded reading, went right to that 18-day average hanging in there. When we come to the GDX, you still have the momentum pointing down, never did embed, by the way. Higher lows, higher highs, back under both the 100-day average and the 18. Not the same in the gold ETF or in the futures. So the gold miners are a weaker configuration than the other parts of the chart. If they wanted to extend their break, 22.24 could be where it goes. Resistance points, the 18 and 100-day average. More or less sideways action, though. The gold-silver ratio was just blown out of the water today. Take a look at this big up move in the market again. So this correction that we had eventually has now given way, and we'll see what goes on. But silver cannot and doesn't seem to be able to make headway on the gold. And you can see how the market got under this last break low, which now all the damage is done. Now you've got a pattern of a higher high and a lower low, and you have a market that is easily get oversold tomorrow if this number gets under 30. So you have a market that's more or less becoming a trading affair out of this thrust that it had to the upside, and it ended really very abruptly. In the copper market, this first challenge of the 100-day average of closes in green and the Bollinger Band failed. That doesn't mean it can't get up and through it, but the first test failed. The market got there and thrown back today 3.5 cents, overbought in addition, and not trending. You have a lower low and a higher high. Don't know what to tell you about that. In the platinum, the market again closed under the 18-day average of closes, and the clear pattern is one of lower highs and higher lows, nothing there. That tells me that its buddy, the palladium, is going to be strong, and it is. And this market's got the embedded reading, higher lows, higher highs. Often, platinum and palladium fight each other. They're looking for spread traders, and you've got it right here where the palladium's just gaining all over it. Now, in the dollar index, going into the FOMC meeting, the first day of it is tomorrow, so I'm saying it proper, the market is neutral. You're right on the 18-day average. You got a lower low, a higher high, a sideways Bollinger Band, momentum no longer oversold, pointing slightly higher, not dramatically, but nobody has real, it's not trending. You've got no trend in the swing line. You have upside bias and momentum pointing up. Two of the three are there. So I look at the markets and you say to yourself, well, what do you do with it? And that's the big question. The stock market got hit very hard today, especially the NASDAQ. That poster child of bull markets got thrown back. It just reopened because it's after 3:30 in the afternoon. But the damage was done, but it also found buyers on that big break. I think now the markets want to see just what's going to happen on the next, if you will, leg of this market. Was that it for the summer rally and the market just turns? We're all going to find out. But when you try to find out, the way to do it is a roadmap. And we've put together with Modern Trader magazine 2 brochures, Guide to Technical Trading, volumes 1 and 2. Altogether about 45 pages of technical guidance on, be it the price charts, Fibonacci numbers, Gann angles, moving averages, stochastics, name it. It's all here. And it's done in a way easy to understand. You can get your copy, and it comes to you by email by calling us at 866-973-2077. I'm Ira Epstein. Give us a call.